Most beginner traders make support and resistance way more complicated than it needs to be. They draw too many lines. They force levels that don't matter, and eventually their charts become impossible to read. In this video, I'll show you a much cleaner way to identify support and resistance levels inside TradingView using simple technical analysis principles that actually make sense. And the best part is that this works across crypto, Forex, stocks, and almost every financial market. If you enjoy clean, beginner-friendly TradingView tutorials and real market analysis content, consider subscribing. Now first, let's keep this simple. Support is an area where buyers previously entered the market and push price higher. Resistance is an area where sellers previously entered and push price lower. That's it. These levels matter because traders and institutions often react to the same areas multiple times. One of the biggest mistakes beginners make is treating support and resistance like exact numbers. Professional traders usually treat them as zones instead of perfect lines. Because in real financial markets, price rarely reverses at the exact same level every single time. Liquidity moves, volatility changes, and institutions often enter positions across entire price areas. Now let me show you the easiest way to find strong levels. The first thing you want to look for is obvious swing highs and swing lows. Basically, areas where price clearly reversed with momentum. Here price moved aggressively higher, rejected the area, and reversed lower. That tells us sellers defended this zone. Now look at the bottom. Price dropped into this area, buyers stepped in, and price reversed higher strongly. That tells us buyers protected this level. The stronger the move away from the area, the more important the level usually becomes. Now here's another important thing. The best support and resistance levels are usually obvious. If you need to force yourself to see a level, it's probably not important. Strong levels should immediately stand out when you open the chart. One reason obvious levels work so well is because more traders are watching them. Retail traders, swing traders, institutional traders, even trading algorithms. And when more market participants focus on the same area, reactions become stronger. Now another thing you want to look for is multiple rejections. Notice how price reacts from the same zone multiple times. Every rejection increases the importance of the level because it shows the market repeatedly respected the area. This is where support and resistance become useful for market analysis. Not because they predict the future perfectly, but because they help you identify areas where reactions are more likely to happen. Now let's talk about a common beginner mistake. Drawing too many levels? This is exactly what you want to avoid. Too many lines create confusion, and confused traders usually make emotional decisions. Instead, focus only on the major levels. Usually 3 to 5 key areas are enough for a clean chart. Your chart should feel simple, professional, easy to read. Now another important concept is role reversal. This happens when support later becomes resistance, or resistance later becomes support. Watch this carefully. Price initially respects this level as support, then the market breaks below it. Later price comes back to retest the same area, and now sellers defend the zone. This happens constantly across financial markets because traders remember these levels. Now before entering trades using support and resistance, always wait for confirmation. This is extremely important. Never enter blindly just because price touched a level. Instead, look for strong candle reactions, momentum shifts, trend confirmation, or additional technical signals like RSI or moving averages. Support and resistance are frameworks for analysis, not magic prediction tools. Now one final tip that can improve your chart analysis immediately: start from higher time frames first. Daily and 4-hour levels usually carry much more importance because they contain more liquidity and institutional activity. Then you can move down to lower time frames for more precise entries. This creates a much cleaner top-down analysis process. Now let's quickly recap. Strong support and resistance levels usually have clear swing highs or lows, strong reactions, multiple rejections, obvious structure, and clean price movement. You also learned why zones usually work better than exact lines, why clean charts matter, and how institutional behavior influences market reactions. If you're serious about improving your technical analysis skills and understanding financial markets more deeply, make sure you're subscribed. New TradingView tutorials and beginner-friendly market analysis videos are uploaded weekly. And remember, The goal is not predicting every move perfectly. The goal is understanding market structure, managing risk, and making smarter trading decisions over time. Thanks for watching, and I'll see you in the next video.